Are you considering refinancing your mortgage? Don't make a move until you know the potential risks and rewards. Hi there. I'm Gurfinkel, a senior loan officer with almost 30 years of experience and over 2,000 families served in my lifetime in the business. I'm here to offer an honest look at all the pros and cons of refinancing and to help you decide if it's the right choice for you. Now, do not like or subscribe if you didn't find this video helpful, but to decide on that, you'll have to watch until the very end. So let's talk about the risks and benefits of refinancing. Should you do it now? So the benefits of refinancing. Well, first of all, the obvious one, right? The lower interest rate. The lower rate is what's going to reduce your monthly payment and help you save on the interest costs over the lifetime of the loan. So let's talk about that in greater detail, please. You've gotten your mortgage at whatever the rate is. Let's say you took out a loan last year when the rates were at their highest and your mortgage rate was at 7.5%. Let's look at some numbers just as an example. Let's say your mortgage balance is $450,000. At 7.5%, that is a principal and interest payment of $3,146.47. We're not accounting for taxes and insurance because those will not change whether you refinance or don't. We're talking about the principal and interest, and that's the part of the payment that actually changes when you refinance and lower your interest rate as a result. Now, let's take that same $450,000 loan at 6.5% and see what happens. The same $450,000 at 6.5% interest, that's a 1% lower than what you supposedly have right now, drops your payment to $2,844.31 a month. If I'm just ballparking the numbers, that's about a $300 difference a month. Significant, right? That's just $300 a month. Times 12 months, that's $3,600. Maybe it doesn't sound like a lot, maybe, but over the lifetime of your loan, that's quite a savings right there. Now, let me run a different example by you. Let's kick it up a notch. Let's say your loan amount is actually $550K, which is more in line with the majority of the loan amounts that I've been doing over the last few years. So let's look at the same numbers and the same interest rates for a $550K loan. $550K at 7.5% interest rate makes your principal and interest payment of $38.45.68. Now let's roll with the same number at 6.5%. That's $3,476.37. Now that's roughly $350, $360 a month difference. Again, I'm ballparking, I'm not using a calculator, so don't judge me too harshly, please. Feel free to whip out your own calculator and run those numbers for yourself. Now let me run one more by you and see what you think. Let's take that $550 to a 6% interest rate, and now your payment dropped to $32.97.53. Now that, my friends, creates almost $600 worth of a difference monthly. Overall, 1.5% change in the rate to the better. Now, why am I sharing the numbers? Why am I going over them back and forth? Well, so you can simply see for yourself what the real benefits of lowering the interest rate are for you. The next benefit is actually something that I personally am not in favor of, but that's just my personal opinion. Let's talk about it for a sec, and then I'll let you decide, and I would love to see your comments actually on how you feel about going from a 30-year to a 15 or a 20-year loan. But for now, let's take a look at going from a 30-year to a 15-year loan to pay off the loan faster and to reduce your total interest. Now, I'm going to focus on the payment just for the sake of an argument. So let's look at this. $550,000 loan at 6.5% interest rate, $37.46.37 a month in principal and interest. Now, if we take that same $550 and drop it into a 15-year loan, please note the interest rates on 15s are lower, so I'm using a 6% interest rate. Your payment actually is going to go up. It's going to go up to $46.41.21 a month. Are you in a financial position to make a bigger payment despite the savings in the interest rate and despite the shorter term? Now, that is a big question that usually I pose to my clients, because while it sounds attractive to not restart your loan at the 30-year mark again, and basically grow from a 30 to a 30. And a lot of people do worry about, well, what about the year or two or even 5 years or 10 years that we've been paying into loan? Well, are you prepared to kick your payment up over $1,000, well over $1,000 a month in this case, to cut the term down in half? Because here is where I'm coming from. Going into another 30-year loan provides you with a guaranteed lower monthly payment, month in, month out. You can voluntarily make a bigger payment and shorten the term of the loan, and I've addressed that in multiple videos in the past. But you do that voluntarily because God forbid something happens to you. Somebody gets sick, you get into a car accident, God knows. You're now obligated and tied to a much higher monthly payment per month. Shortening the loan term does work for some people. It is not a prescription for everybody that I would recommend personally. Of course, there are other loan terms besides the 15. There's also a 20, a 25, there's also a 10, by the way. So yes, we can look at individual prescriptions versus a more general topic. But as a general rule, this is something that I try to focus on with my clients because what may sound attractive on the surface, the reality may be biting you in the ass. Another reason people refinance and derive a benefit from it. And frankly, this one is also tricky because you can actually go from a lower interest rate to a higher interest rate and still reap the benefits by utilizing a cash out refinance, or as we refer to a lot of times, as a debt consolidation refinance. Because what you have as equity in your home, that's really technically dead money. I mean, yes, it looks great on paper. You bought a house for, let's say, $300,000, now it's worth $500,000, you have $200,000 in equity, woohoo! You've arrived. Well, how do you access that $200,000? Because unless you can actually touch that money physically, that money is just sitting there. It's just money on paper. Yes, it is your nest egg when you sell or when your family sells, but in the meantime, how do you access it? How do you get to it? And cash out refining is one of those ways to access your equity. This is where you look at your overall debt structure, what else you have going for debts and monthly payments, not just the amount of debts, it's the monthly payments that are more important. And how much a cash out refinance, meaning debt consolidation, meaning your current mortgage, possibly your car loans, possibly your student loans, possibly your credit cards, whatever you got going on, right? What are you going to save out of a monthly payment when you roll everything up into a one new loan? Now let's talk about the risks of refinancing. You're gonna ask me, like, what are the risks? Why would there be risks? Well, simply put, refi is not free. And by the way, the companies that tout the no-cost refis, buyer beware, because there is no free lunch. There are appraisal costs, there is title and escrow company costs, there are lender costs. There are a number of line item dollar figures associated with your refinance that frankly don't come out of thin air, and nobody's gonna waive them just because you're a great person. I mean, I like you, don't take me wrong. I would love to waive them for you, but they're not my costs to waive. There's third-party costs that have to be paid and have to be covered. And those costs typically add up. The refinance cost, just the closing costs alone, may run somewhere in the vicinity of $4,000 to $6,000. However, the upside is that on a refi, you do have the option of automatically bundling or rolling in your closing costs into the loan, so you're not coming up with that cash to close out of pocket like you potentially did when you bought the house. So that's an upside. But you're still increasing your loan by the amount of closing costs. So let's say you borrowed $450,000 originally, and now your closing costs are, let's say, $5,000 for even numbers, and maybe there is another $5,000 to $10,000 in prepaids, as in taxes, insurance, what have you. That's potentially $10K that you're adding to your loan. So you started out with a $450, and now your loan is going to $410. So this is where the risks begin, because now you have to look at the impact to payment versus the reward of monthly savings. And you also have to look at the total costs and fees, because the higher the fees, the higher your monthly payment, the more it eats into your potential monthly savings. So closing costs, definitely a risk. Prepaids, taxes, insurance, definitely a risk. In some states, like Oregon, for example, which is my home state, used to be, taxes are paid once a year. Basically, if you're refinancing too far away from the due date of the property taxes, which is November 15th, you're adding a huge chunk back into your new loan to cover your property taxes. The other risk is resetting the loan term. Personally, I don't look at it as a risk, but some people do, and that's why it falls into the risk category. Yes, a lot of people cringe at basically starting over a new 30-year loan and extending the time to pay off the mortgage and increase total interest. For reference, there's a number of videos I've done on how you can pay off your mortgage faster, and paying extra principal is definitely one of those ways. So when is the refinance actually worth it? That is a loaded question. It used to be back in the day, and I hear that misconception a lot actually still, that your interest rate has to be at least 1%, if not 2% lower on the new loan than on the original loan. Now, let me give you a little bit of a historical trivia and explain to you where that misconception comes from. And that origin story goes back to 70s, 80s, and even 90s, when the price of homes was significantly lower. Again, real life example, my parents bought a house for just over $100K back in 1992. Yep, that was a pretty typical price of a home in the Pacific Northwest. If you took out a loan of roughly $100K, just using even numbers, anything less than a 2% difference absolutely made no sense to refinance because there was no savings in a monthly payment. And that's where that urban myth originated from. As the home prices increased, as the loan sizes increased, mind you, back in the day, I think it was in the 90s, somewhere in the late 90s, where an average loan size was like 170,000. Yeah, you had to have a much bigger delta between the original rate and the new interest rate for the refinance to break even and realize the savings. But now, like I said, when the average loan size is somewhere in the 4s and 5s nationwide, come on, that's like more than 3 times what it used to be in the 90s, right? So the bigger the loan amount, the less interest gap it takes to realize the monthly savings. Whenever the interest rates drop, again, consider how much of savings is enough. Because yes, you can refinance about every 7 months or so, and no, you're not limited to one refinance in your lifetime. Is it worth it to keep refining over and over again? For another conversation. Personally, I don't believe in that. But when the interest rates do move lower, refinancing out of a higher interest rate is definitely something that pretty much everybody with the rates over 7 absolutely should consider. Now, if you're one of the people whose credit scores have improved from when you took out the original loan, refinance can actually lead to better terms, better loan types, and a lower monthly payment as a result. Let me give you an example. I financed a client this summer whose credit scores were in the mid 640s, if I'm not mistaken. We had no choice, pretty much, but to put him into an FHA loan. Even though they put down a chunk of a down payment, a big chunk of a down payment, we still had FHA as the better solution because of the lower interest rate FHA affords compared to conventional when you have lower credit scores. Now, as we're working on improving his credit scores, and as the rates are coming down, we're actually working on a goal of refinancing this client into a conventional loan so we can actually get rid of the mortgage insurance because of the chunk of a down payment that he provided when he bought the home. So improved credit scores are another factor that allows you to reap better benefits. So not just 1, 2, or 3 benefits, but like a whole slew of benefits when refinancing a home. When should you refinance? Typically only if you're planning to be in the house long enough to recoup the actual cost of refinancing versus the savings of the refinance. Let's say your break even is going to take about 4 years, but you're not going to stay in the house for more than 2, then hey, there is no point because you're still going to get rid of this mortgage before your break-even period arrives. So look at the numbers. Don't get roped into a refinance just for the hell of refinancing because the rates are better, because it looks better on paper. Think about the long-term planning. If you've done a loan with me, you know one of the things I always tell you from the get-go is that let's look at the bigger picture. I don't want you to throw your money down the drain effectively. And I don't want you to increase your loan amount more than you need to by refining and adding closing costs into it. I just want you to be in the best financial position than you can be for yourself at this particular time. Should you refinance or not is not a generic yes or a generic no. It entirely depends on your situation, on your financial plans, and on what benefits you will reap from refinancing. All of that are individual decision points that you should consider. I can't answer that for you because you, my friends, are going to be the ones paying on that new mortgage or the existing mortgage, not me. I'm just here to provide the sound financial advice. Now, remember, do not like or subscribe if this video was not helpful. But now that you know everything about the risks and rewards, was it worth it? Let me know in the comments.